Welcome, everyone, and thank you for joining us. I hope you're remaining safe and healthy as we work through these challenging times. I'm happy to have the opportunity to interview today Mike Kirby, the co-founder and director of research for Green Street, a firm that provides actionable intelligence that keeps commercial real estate investors like us on the leading edge of where the markets are headed. Green Street covers 125 listed real estate companies and works to bridge the knowledge gap between the public and private real estate markets. Welcome, Mike. Thank you for joining me today.
Thanks, Bill. Great to be here.
Mike, GDP in the second quarter was 10% below pre-COVID levels. High-touch industries seem to be the largest losers. Economic activity has improved, but infections certainly remain far from under control. The U.S. is unlikely to end social distancing measures until, until we find a vaccine that is proven to be effective and available. From your perspective, the perspective of Green Street, what is a realistic target for the end of the pandemic?
Well, I don't think we're the ones to tell you the absolute best answer to that question, because it's not right in our wheelhouse. But I guess as investors, we all need to have opinions on, especially on this one, in forming a base case. So our base case is that somewhere around the middle of next year, we have a functioning, widely distributed vaccine, and life has again returned to normal. Which will allow the economy to get going back at something approaching full speed. But when I say full speed, even middle of next year, we're not going to feel that great, because this has been a deep, deep hole. So our GDP forecast calls for us getting back to 19 levels, call it 3Q22. It's going to take a long time. It's a deeper, longer hole than the global financial crisis. So, the good news is we can see light at the end of the tunnel, but it's pretty far away.
Got it. Yeah, we've noticed a huge pricing variation across public market property sectors. The office sector has received a lot of negative press, while the outlook for multifamily is generally positive in this post-COVID environment. I think looking at overall REIT implied unlevered valuation declines, the declines in office were around -9% and multifamily at about -8%. These values are very close, and REIT office rent collections have actually outperformed multifamily. Do you think the market's misreading and certainly misreading the relative risk between the two sectors, or is this specific to the REIT holdings that Green Street covers?
Yeah, I mean, I think you may be using some of our numbers there, and I'll expand on those.
Yep.
We believe that that's what values have declined in the private market, something like high single digits in both cases. It's a little hard to say for sure. We've seen some apartment transactions, not so many office, but somewhere in that ballpark seems to be where the dust is settling. The public market implied pricing is quite a bit worse than that. So we can extrapolate from share price behavior and de-lever it. And the unlevered decline in the price of the REITs has been somewhere in the 20 to 25% ballpark for both sectors. And they're pretty close. Apartments are down just a little bit less than office, which I think buttresses your question. Why is the public market hitting apartments as hard? I mean, it doesn't really make a lot of sense. And based on the near-term hits to NOI, apartments are going to do poorly. They don't have lease protection. And then where we land, say 3 years from now, they're both going to get hit. I mean, apartments are far from immune to what's going on out here. We've got a lot of the apartment REITs own pretty heavy urban portfolios. You can't have this big an unemployment issue and not have apartments get hit. Supply has been high and still is high in the apartment space. So it's far from a sanguine outlook there. when we do our math as to what the long-term valuation hit for apartments should be, so we look at near-term cash flow hit, intermediate-term cash flow hit, and then is there some long-term hit to fundamentals, which we don't see in apartments, we come out at about 10%. So in the case of apartments, we don't really understand what the public market's saying. We think the public market is overreacted. In the case of office, we get it. I mean, in the case of office, again, the near-term hit is not quite as severe. The intermediate term hit is it puts you up in that 10% ballpark when you add those two together. But where office fares worse in our analysis is the long-term impact. So by long-term impact, I mean what happens starting in 2024 and then stretches into perpetuity. And that's where I think some of the work from home stuff does play into our analysis. And we don't think the office of the future is going to look like the office of the past. We don't think the business model of most tenants is going to look the same. Now, I'm not saying everybody's going to be working from home, but we do think there's going to be a notable increase in the number of people that have flexibility to work from home. And it's going to have an impact on office demand. And office demand it wasn't strong to begin with. And so if you do anything to hit it, and our numbers say maybe a 10 to 15% total reduction in demand over a 5-year period, that's bad news. And so, with office, we sort of get the public market's reaction. Our numbers put us in the high teens in terms of the impact that should have happened. Apartments do seem like they've been whacked too hard, both private market valuations and public market valuations.
Yeah, got it. In looking at income and wealth inequality, it's been growing in this country for many years, and the pandemic has been making things worse with layoffs, particularly concentrated in the low-wage jobs. But it's also prompted an action by a divided government, and I think this action is likely going to lead to higher taxes. Will higher taxes, in your mind, disproportionately affect the demand in higher cost gateway markets, or what's likely to happen there?
Yeah, I think fiscal health at the municipal and state levels is one of the issues of our age, and it's one we've all known is coming. We've all been talking about it for at least 10 years, but COVID has accelerated it along with other things. And they all of those impacts from COVID sort of point at gateway markets. And, the blue politics, or where the fiscal problems are, it's also where a lot of the social unrest is, which is, I don't know where that plays out, but I don't think it's good for real estate. And then, work from home, all of a sudden, we found to be viable in many cases, and that probably doesn't play out too well for the gateway markets. So you've had this triple whammy of impacts emanating from COVID, where fiscal health being one of the biggies, where how are these cities going to fix their revenue shortfalls? Well, they're going to tax people and they're going to scare people out. And we've seen a lot of ballot initiatives, a lot of legislative proposals already. Where California and New York have approached the idea of a wealth tax. Certainly both states have talked about raising the marginal rate, California now to 17%. At some point it breaks, and you can't have the tax discrepancies that are starting to appear between certain gateway markets and certain Sunbelt markets without impacting demand. And we think we're there. We think we're at the point where investors have to really start focusing on that. It plays a pretty big role in our evaluation. It's a formal variable as we evaluate the markets, and it's one where we recently changed our long-term growth rates due to the fiscal health outlooks for the various municipalities.
Yeah, interesting. Well, another thing that we've been tracking is a desire for space, mobile jobs, record low mortgage rates, and the fact that all of this seems to be causing families to purchase homes in the suburbs. while those without jobs are doubling up or they're moving in with their parents. Is the combination of these things producing a strong headwind for apartment owners, you think? Because we worry about that a little bit, and particularly those in high-cost urban areas that you pointed out just a few minutes ago. And it might even appear that single-family rentals may actually come out of this a big winner. What are your thoughts on that?
Yeah, I mean, so everything you said jives with what the public market's already done, and it's sometimes good for private folks to just get an overview for what the public market's done. And the single family rental REITs have been on fire. They're barely down since COVID started. Their operating performance has not skipped a beat. They're doing very well. The business is as good as we expected it would be before COVID appeared, which is that's quite a statement considering how apartments are doing, where everybody's been hit. But the Sun Belt has been hit a lot less hard than the gateway markets. And so New York, San Fran are the two hardest hit. Those you've seen revenue declines that rental rate declines that are substantial in both markets. Leasing concessions are high. We don't know where it all ends, but it's probably got further to go. Whereas Sun Belt markets, you're down, single digits, mid-single digits, and there's a lot of signs of leasing life. There's a lot of evidence that those markets are at least troughed, whereas we just don't know when that happens in some of the urban markets. And then the big variable with both, I guess, with any residential rental property is just this unknown of what happens now that the stimulus checks have stopped, and are they going to start again, and how big will they be when they start? And then the foreclosure forbearances that have been in place. Do we just have our fingers in the dikes, or are we really seeing stabilization? We won't know for a while. But yes, the suburban markets are definitely outperforming the gateway markets. We expect that to continue. There again, it's something we've formally adopted into our projections and changed our growth rates accordingly. And single family rental has been a fantastic business and probably will continue to be.
Yeah, oh, very good. So taking all this into consideration, how would you summarize your expectations for NOI growth? And I know you're probably thinking it's different across the various sectors, but how would you just, because we worry about that a lot.
Yeah, it's a hugely different answer depending on which sector you're talking about. Some sectors are just skating through this just fine. Industrial's doing fine. The impact on NOI is barely measurable. Others, hotels, the impact on NOI is 100%. It's they're not going to report NOI this year, or at least positive NOI. It's hard to generalize, but when we do average the key sectors that we follow, we come up showing 2020 being about a 20% decrease in NOI. And then it perks back up. It's a deep trough. It picks back up. But even by 24, the impact to NOI is something like 8%. So if you say, what's the long-term damage to real estate NOI done by COVID? We think it's somewhere in that ballpark, which sort of roughly jives with what we think the long-term impact should be on valuations, again, with huge variances across sectors.
Yeah. As I look at the bond market, and obviously we have to track the bond markets in the public real estate markets, I'm always asking myself, what is it telling me? What can I learn from these markets? And I know you have some thoughts on that, and I'd love to hear what they are.
Yeah, I mean, we've looked at the same thing for a long, long time. It's something we've tracked for over 2 decades. And I guess the good news for real estate is everything looks cheap relative to bonds these days. I mean, the real yield on a 10-year bond is -1. It's more than, or it's even lower than -1.
Yeah.
And which is a stunning statement. And when you start to reference anything, the value of any asset off of that -1, you come up with the ability to value it pretty richly. And that's clearly the case with real estate these days. But even if you take bonds with some risk on them, so investment grade corporates, real estate looks cheap. I mean, on any time series you draw, comparing real estate returns versus investment grade corporates, real estate is screening very attractively right now. Screening a little bit less attractively relative to junk bonds. But with the Fed in there buying bonds these days, it's the alternatives that an investor has to find reliable income streams are not great. And so real estate, to the extent there's a bull case for real estate these days, this is it. And then you can also look to how are REITs priced versus capital market alternatives like stocks. And there again, the comparison is pretty favorable. I mean, if you look at the multiple on REIT earnings versus the multiple on S&P earnings, we're on the cheap side these days. Not quite as table poundingly as we are with bonds, but still every signal points towards real estate being a pretty attractively priced option, public or private.
Okay, very good. Well, I'm looking at the REIT market. I'm looking at current prices relative to the public market. I'm certainly looking at NAV. Do you see opportunities for private companies to acquire REITs at a discount right now to NAV?
Well, we've got NAV here again. It's the tale of 17 sectors, right? I mean, that's what we have in the public space right now. We have 17 different property sectors, which I'm sure a lot of private real estate folks don't even know there are 17 different property sectors. And the differences in both performance and pricing has never been greater. And you described it earlier as high touch spaces being the ones that have been hit. Well, that's definitely true. A lot of types of real estate are high touch, and the ones that are high touch are doing very poorly, and they're being priced very poorly too. And so, meanwhile, you have some REITs trading at sizable premiums to NAV, and I think this was probably newsworthy to some folks that on average, across the sectors, REITs are trading at a premium to NAV, which sounds odd to anybody that focuses on core real estate, because they look at retail and at retail, apartments and office, and they say, what premiums? So those premiums, I mean, the discounts across the core sectors are large. And you have New York office REITs trading, in some cases at 50% discounts. High quality companies, SL Green, Vornado, Paramount, Empire State. The NAV discounts are, it's about half. Boston Properties, premier office owner perhaps in the country, minus 30. You've got the same thing going on with the apartment REITs, where the discounts aren't as severe, but the gateway focused folks, EQR, Avalon, UDR, you're looking at 20%. And then hotels are another sector where it's heavily discounted. You have very high quality names in the hotel space, or at least 25% discounts to NAV. So it would seem that the opportunity is there for some privatizations, and we will see some, but maybe not as much as you might think. That sounds like a feeding frenzy about to happen with those numbers I just threw out. But I think we all have to question what is NAV? And we can define NAV a lot of ways. When we define it as the price that it's the sum of the pieces. So it's single asset pricing added up to reach the value of the property portfolio. Now, am I confident that Manhattan office buildings still sell on a one-off basis for a cap rate that starts with a 4? Yes, I am, because there's some transactions to say that happens. Am I confident that there's a portfolio bid for a $10 billion office REIT? I'm not confident in that at all. And so we really have to get, we have to ask the question, who is the buyer on some of these very large transactions? And you've got some big players out there, and they're pretty good at telling you where they might go. And as far as I can tell, they're not going into New York office REITs. And then you also have the social issues that you always have with REITs, which is if the board and the management team are not willing and looking to sell, it's tough to get a deal done. And in a lot of these cases, the boards are focused on where their share prices used to be. And the idea of selling at such a massive discount to where the stock was trading a year ago is just, it's a very difficult thing for them to stomach. Right or wrong, I think it's wrong. I think it's the wrong way to think of the world, but it is the way the world works. So, that said, the Blackstones and Brookfields and others of their ilk have massive piles of capital to go spend, and some of it will be spent on public companies.
Sure. Well, we've seen a shift in the NAREIT index lately, where more than 50% of the index is focused on what I call non-traditional sectors, the non-core sectors that you mentioned earlier, things like senior housing and student housing and self-storage and et cetera. Given the challenges facing retail, hotel, and potentially office, do you expect this to ramp up even more?
Yeah, I do. I think one of the things, look, the private market does some things better than the public market, and the public market does some things better than the private market. I think one of the places the public market has really done a good job over the years is accepting non-core property types as real estate and underwriting them and embracing them. And in the vast majority of cases, it's worked. I mean, the best performing property sectors, almost without exception, have been the non-core sectors over the years. And as a result of that, we've gone from an industry that in the public market had 7 or 8 sectors to one that has at least 17, and you could cut it more tightly than that and have even more. The numbers are pretty stunning when you look at the composition of the broadest REIT index, where 20 years ago, 80% of it was core. Today, about 35% of it is core. So 65% of the REIT world has nothing to do with core real estate, which is a pretty stunning statement, but I think it's something that private investors should pay heed to, because let's just step back and say, let's ask why core is called core. Well, somebody invented core 35, 40 years ago, and they said, this is real estate and this other stuff is not. Well, we now know that this other stuff has a lot of investment attributes that are at least as good as, and in many cases better than core real estate. And it in many cases, the NOI growth and CapEx profile is much more attractive than, say, the king of core, office. And it's also the real estate of the future. So if I think of data centers and healthcare and cell towers, to me, and I think, where would I want to be 15 years from now? I like those businesses a lot better than office and retail. So yeah, I think we're fated to continue to go down that path. And I would encourage every real estate investor to keep a very open mind as to what constitutes real estate, because some of the things that were viewed as funky real estate 20 years ago, self-storage, manufactured housing, not only do they perform brilliantly, but we found that, now I think it's universally accepted. Of course, they're real estate.
Got it. Wow. Yeah, I can tell you that I did a research piece a while back with a couple of my research colleagues where we were able to tease some non-traditional real estate out of the NACREIF index on the private side and compare it to the public. And we found exactly what you just said, that the performance in the non-traditional sectors was absolutely amazing on a comparative basis.
Right.
And I think, in some ways it was so much so that it was very surprising and a very eye-opening. So yeah, it'll be interesting to see how the industry evolves. Mike, I was going to ask you, which REITs do you think are the cheapest right now? I don't know if you're comfortable answering that or not. If not, I'll move on and we'll wind this up. But if you want to throw out some ideas, I know the market would love to hear them.
Well, I mean, we answer that question every month, and a lot of our answer is dependent on which sectors we like.
Yeah.
And so the sectors that jump out, and probably not too surprisingly from some of the comments I've made on this call, are apartments we think are cheap, manufactured housing we think is cheap, single family rental, great business. So and in each of those spaces we have a couple names typically. So Equity Res and MAA in the apartment space, Imitation Homes and AMH in the single family rental space, ELS and Sun, which are the two of the four best performing REITs over the last 25 years in the manufactured housing space, still good value. So it really, I don't think the answers would be too surprising based on where we've gone in the call, that our strongest buys are focused on some of those sectors where we think maybe the public market's overdone it in the correction here, and or they just are a still misunderstood niche sector like manufactured housing.
Got it. Well, I think our time has come to an end. And Mike, I want to thank you for taking time out of your schedule to chat with us today. I also want to thank Gunnar and the AFIRE team for working to make this interview possible. And last but not least, I want to thank the audience for joining us. Until we have a chance to see you all again in person, please be safe. And we look forward to being together again at some point. Thank you.
Thanks, Will.